Good afternoon, everyone. Thank you to the organizers of the Vietnam Blockchain Association event, the RWA event today, and thank you for inviting me and Binance here to give our keynote speech today. This is a very exciting moment for Vietnam. Digital finance continues to evolve and in the direction of real-world asset tokenization, which is the theme of the convention today. Before I start on my presentation, there's a few things I want to touch on. So firstly, I want to touch on the fact that real-world asset adoption is not driven primarily by technological developments. The key things that consumers care about are not actually what happens in the back end. The key things that they care about is how their user experience is when interacting with these instruments. And a lot of that comes down to basically, as some of the presenters have mentioned before, the legal rights associated with their holdings of these real-world asset tokenized versions. So that means, what exactly does it mean when I'm buying a tokenized version of an asset class? What are the legal rights that I get or derive out of owning this tokenized version as opposed to owning the underlying asset? And that is a key component. None of this is entirely new. We've had real estate investment trusts, we've had securitization of assets for a long time. And the legal and governance structures around these instruments have been quite constant over time. The major difference is actually the fact that these instruments are now being placed on the blockchain layer of technology and therefore being available 24/7. So that is something that we need to bear in mind when we talk about real-world asset tokenization. It's a technological shift with a lot of replication of underlying governance and legal tools that have existed for quite some time. So we're not exactly starting from scratch, which is a good problem to have. And today's discussion is not about promoting one type of technology or one type of service provider over another. It's really about sharing lessons from international markets, from our experience as a centralized exchange, which may be helpful as Vietnam starts to build its own framework around real-world assets, tokenization for sure, but more broadly, digital assets. The key theme of my presentation today is that innovation will only truly succeed on two grounds. The first is that users truly understand what is being offered to them and how this is distinct from traditional asset classes that they are used to. And the second, innovation in this direction will only truly succeed when it is accompanied by trust on the part of the users in the actual architecture of the tools being developed. I'd like to cover three main areas today. First, why trust has become the key ingredient for the foundation for successful financial innovation. Secondly, what can we learn from global markets which have already begun implementing tokenization and digital asset frameworks? Vietnam is not the first market to move in this direction, obviously. Some of the other presenters have talked about Singapore, Hong Kong, Japan, Korea. One thing that was missing from the slides was actually Australia, New Zealand, as well as the UAE. And finally, why I personally believe and why Binance believes that Vietnam has a unique opportunity to build a very trusted digital financial ecosystem which supports long-term growth and innovation. So before we talk about tokenization of digital assets, I'd like to start with a much broader point about financial innovation. History shows us that technology alone doesn't transform financial markets, or any market for that matter. It is actually the confluence of technology and a demographic shift that is eager and ready for that technology innovation. And this reaches its full potential when people actually truly understand the systems and the technology that they're actually engaging with. Users need confidence that markets are fair, orderly, and constructive. Institutions need confidence that regulations and rules are clear and are there for the long term and are not going to change in unpredictable directions. Regulators, of course, need confidence that the market participants are genuine and that the risks that arise from this new business model can actually be managed in a meaningful way. This is why trust isn't something that comes after innovation. It actually precedes innovation, and it's a critical ingredient for innovation to succeed. On this slide, you'll see three main elements that support trust. The first is legal certainty, and I talked about that at the beginning. People need to understand that these legal constructs are stable and that they're actually enforceable. So if you buy something and you want to enforce your rights, you need to be able to do that. So classically, you want to be able to redeem the token for the underlying asset. I'll talk more about how Binance has done this for some of our equity offerings globally on a tokenized model in time to come. Secondly, effective risk governance. So the product has to be designed, rolled out, and distributed in a way that manages risks for consumers. And thirdly, participants need to understand that there's market integrity and that these are not barriers to innovation, but actually they are foundations on how the innovation can grow. So regardless of technology, the objective should be the same. Build trusted market infrastructure using trusted brand names that have been there for the long haul, and encourage responsible innovation by these market participants while giving customers the tools, the knowledge, and the experience they need to make those financial determinations for themselves in a way that's safe and which takes into account their own personal financial standing and position. Now, once these ingredients are in place, we can move into actually the real-world adoption phase. And that's exactly what we're seeing in global markets today. Just a few years ago, tokenization was discussed as a future possibility. I remember attending conventions like this a couple of years ago. And the theme of those conventions was, is crypto a legitimate thing? Is it the next big scam? Fast forward to today, we're actually talking about real-world adoption and measurable adoption of something as advanced and as complicated as real-world asset tokenization. Now, if you look at the chart on the left, that's a McKinsey report from 2024, which predicts on a base assumption, not even a bull market assumption, a base assumption that we could hit $2 trillion USD by 2030. And more optimistic suggestions are almost double of that. Now, you'll notice that the largest opportunities are in cash and deposits, mutual funds and ETFs, securitized assets and alternative funds. It is not a coincidence that about a decade into digital asset technology, we used to call them DLTs, right? Digital ledger technologies. We're still talking about financial instruments, largely financial instruments that are the subject of real-world asset tokenization. And the reason for that is this is actually the simplest way to experiment on and encourage large-scale adoption of tokenized assets. We saw some of the presentations earlier talk about IP and land. Those are arguably more complicated areas to actually tokenize. And I think a lot of the learnings from financial services or core financial products will become the foundation for us to be able to move tokenization to other categories of asset classes, including supply chain, IP, and so on and so forth. As I mentioned before, tokenization is not a process of creating a new asset class. There's this misconception sometimes that we are creating entirely new asset classes. We're not. We're merely making existing asset classes more accessible, more liquid, with less barrier to entry, and less barrier for transferability of rights of those assets. Now, the key takeaway is that we've entered a whole new phase. If you look at the chart on the right-hand side, you can see that there's about 34 billion in tokenized real-world assets. Let me talk to you for a moment about Binance's experience. We have at the moment about 320 to 330 million customers worldwide. There are about 700 million crypto asset holding customers globally on a conservative estimate. That number is already larger than the number of people who hold stock brokerage accounts globally. So the shift from traditional finance, from traditional fund markets to a tokenized version or digital asset version of life has already gone past the point of equality, right? So there are much more digital asset holding customers compared to traditional fund holding customers globally at this point. And we are barely scratching the surface. Now, this naturally leads to the next question. Let's assume for a moment that we can run this marketplace responsibly, we can scale this while minimizing risk to consumers. The question is, why are so many institutions and market participants investing in tokenization in the first place? What are the pain points they're trying to avoid, and what practical benefits does it actually deliver? As I mentioned early on when I was on the panel, understanding the demand side of the equation is going to be critical in terms of designing the next wave of products, because without intelligent design, we're not going to have adoption. A lot of these themes are talked about today, so I'll keep this fairly light. Firstly, fractional access. On the Binance platform, you can now access US equities for as little as $5 in terms of the minimum buy. Now, if you try to do the same with most traditional brokerages, you're going to run into multiple friction points. Firstly, the number of intermediaries you need to get through. You probably need a brokerage account first, and the brokerage account will be limited in terms of the exposure it gives you to the US equities market in general. On top of that, the minimum spend you have to make, or the minimum amount of shares you can buy, there'll also be a base limit or a floor, which means that these asset classes are most of the time priced out for a large number of retail customers. What tokenization does is it allows you to break that minimum size of a share into smaller and smaller units, which means that there can be more and more fractional access to what is typically known as the base stock size. So that's the first, which means your entry point for investment becomes much lower. We heard from the esteemed doctor earlier that one of the things we want to control for in Vietnam is actually consumer risk for the domestic market, and to make sure that people do not invest beyond their capabilities. Well, fractionalization allows people to invest up to the limit of their capabilities. Secondly, broader market access. Tokenization allows global products to be made available to a user base in country X. And it allows this access to happen through a singular platform. The race for the future is not merely on a single asset class. The race for the future is on which platform can give users the maximum number of products in as safe and as stable and scalable a platform as possible, without having to switch between app environments or site environments, website environments. So users want a one-size-fits-all and a one platform that offers all products to them. And so broader market access becomes then much more accessible through a tokenization model. Improved liquidity potential. This has been talked about a lot before, so I won't go into that. Transparency and auditability. One of the beauties of having on-chain transactions is the fact that these ledgers of wallet addresses and the movement of assets between wallet addresses are publicly auditable. And so, unlike a traditional financial services model where you are reconciling between the ledgers of multiple different financial institutions, on a blockchain model, that is simply not necessary. And the record is there permanently, immutable, for all to be able to track and trace. So the value isn't technology itself. The value is, what does it actually enable? Apart from improving liquidity and making assets easier to transfer, and fractional ownership, which lowers the investment barrier, it actually then connects issuers and users directly through digital infrastructure. So the Tether team earlier talked about how they provide the infrastructure, and then based on the infrastructure, you have market makers, you have issuers, you have legal structuring advisors working together. All that is invisible to the user. What the user sees is a single platform that offers them a universe of investment opportunities at an affordable cost in a way they can intuitively understand, and a dashboard they can see every day and be able to see their assets under management on a daily basis. And should they want to get access to the underlying assets, they can do that with a click of a button within the app environment itself, because there's one-for-one redemption of the underlying asset. So for example, when Binance offers US equities, it is actually redeemable one-for-one for the underlying equity without delay, instantaneously. So when we talk about tokenization, we're talking about building a much more efficient financial system, one that is future-focused and actually one that is much more attuned to the preferences of the users. That's what I meant by the demographic shift. It's what the digitally savvy generation actually wants. And it's more about making that efficient rather than replacing the existing financial system entirely. So far, we've talked about the supply economics. Now, the figures on this slide highlight a significant gap in today's financial system. Only about 11%, as I mentioned, of global users have a brokerage account through which to invest into equities market or even the debt market, the bonds market. According to Binance research, the vast majority of people in this world still only have limited access, therefore, to traditional investment markets. At the same time, when we launched stock trading on Binance, we surpassed $1 billion USD in assets under management within the first 30 days. When we launched tokenized versions of gold and silver, as well as tokenized versions of pre-IPO stocks, such as SpaceX, those became the most invested into categories of investments within days of their launch. This is just one product, but it reflects a much broader structural trend that users are looking for much more accessible and efficient ways to invest. It's a function of time, and it's a function of friction. Now, normally when you invest into equities, you have to go through multiple intermediaries, as I mentioned before. And what we're doing as a digital platform is changing that by making sure that with a click of a button, you make the decision for yourself with as minimum interference as possible from the platforms. Now, the key takeaway is that this future is already here. It's already happening. I think one of the teams shared earlier that in Bolivia, you can buy these instruments for tokenized versions of the US dollar at this point. That reality is also mapping across to the investment space. When people invest into assets for their personal financial portfolio, it's mapping into remittances, it's mapping into trade finance, it's mapping into companies using tokenized versions of assets to settle between themselves. Now, there's also the financial engineering component. This is the base case. Now, when you hold tokenized versions of an asset, because it's highly liquid, it's then much, much more possible to pledge that asset in exchange for participation in other markets as well. So it becomes collateral in your hands, which makes it easier for you to then pledge that collateral in a very transparent manner, in a very price-transparent manner, right? An orderly functioning marketplace to be able to take positions in other instruments. Now, this demand is exactly why regulators around the world and governments around the world have been focused on developing frameworks that encourage innovation while maintaining market confidence. So we saw earlier on the slide, go too fast on regulation and you throttle the markets and participants move out to unregulated platforms. Go too slow and the risks build up. And so I think regulators are trying to find that balance, and it's the responsibility of platforms like us, based on our user understanding and global regulatory experience, to support that initiative. Now, we've seen around the world, different countries have taken very, very different approaches to digital assets and tokenization. There's no single formula that every market follows, but there are some key principles that all regulators globally have adopted. Much was said about MiCA earlier, and the Singapore PSA framework and Hong Kong, etc. There are a few things that I want to bring this conversation back to. The first is that to have meaningful regulatory frameworks, it has to be a framework that accommodates players of different sizes, right? So same risk, same control principles, and I think a legislative framework that accommodates the market participant type makes sense. So an exchange, for example, is very different from a broker, a dealer, and they're very different from a market maker or a hedging venue or a liquidity venue. So the licensing methodology has to accommodate the different roles that market participants play and the different regulatory capital that we require, the different buffers that we require, and the different kind of compliance programs and processes that we require depending on their function. The second is that there has to be a licensing framework that accommodates the different types of asset classes. And so as I mentioned before, on the demand side of the equation, there is very, very strong and clear demand for a broad universe of instruments and services and tools. And if the licensing framework is unnaturally restrictive in that sense, it will result in users moving towards unregulated platforms. At the same time, I think regulators need to figure out which are the top 5, 10 product categories that matter to users, and then think about regulating them in a sensible fashion. As I mentioned, a lot of these asset classes already exist in the traditional world, and the tokenization or the blockchaining of these asset classes don't materially change the risks. They make them faster, higher velocity, quicker movement across border, but again, the tools to regulate them can be proportionate and commensurate. So principles including technology neutrality are also important. There's only so many jurisdictions in which an exchange can fracture their order book or their liquidity venue in two before it starts to impact liquidity and price. And so I think there's also recognition by the leading tier 1 jurisdictions around the world that of home jurisdiction or home regulatory recognition. So for example, if Binance is licensed and supervised and regulated in the Abu Dhabi global markets in the UAE, then other regulators take comfort, for example, from the fact that we have a global order book and a global exchange that's already regulated, and then they regulate us as a broker in the local context. So that's one example of technology neutrality. Also, custody. This is always a common topic. So custodizing a cold wallet locally versus custodizing the actual technology stack, or rather regulating the actual technology stack, are two different things. The more jurisdictions in which the technology is localized, the more points of compromise or the more opportunities for hacking, etc. So we need to balance the risks introduced to business as a result of regulatory frameworks versus the benefits. So clearly defining ownership rights, issue responsibilities, transfer mechanisms, these are all critical parts of and very common methodologies among regulatory frameworks. Now, question is then, what can Vietnam draw from these international experiences? Should it take any inspiration from any of them at all? Or should it take its own approach to developing a framework that reflects its own priorities and national ambitions? These are some examples of globally systemically important institutions versus national regulators. The list is pretty long, right? So what do these principles look like? Now, from an international organization, IO point of view, their priorities have been, in terms of investor protection, disclosure, custody and market integrity, cross-border risks, financial stability. So depending on the international organization you speak with, they have slightly differing priorities. But what we can take inspiration from as a national framework is from markets like Japan, Korea, Australia, Singapore, Hong Kong, obviously. And they've all moved at different speeds. So a quick snapshot. While Singapore and Hong Kong moved very aggressively and very pro-business early on, at the moment in the UAE, for example, there is a much broader shift towards innovation in a much more permissive environment. So as I mentioned earlier, licensing activities and licensing market participants based on their role has been quite instrumental in the growth of this industry in those regions. Particularly talking about stablecoins and real-world asset tokenization. On stablecoins, we have the usual benchmarks in terms of MiCA. We have the benchmarks, but again, one of the things that we need to bear in mind is what is the purpose of stablecoin in the domestic regulatory framework? Is it merely an on-ramp, off-ramp feature for market participants in crypto trading? Or is it actually long-term a payment and settlement mechanism, not just for corporate settlement, but also for retail merchant activity? And that, I think, will define the licensing and regulatory framework for stablecoins. In terms of real-world asset tokenization, going back to my earlier point when I started this keynote speech, it comes back to what is the overarching ambition. A lot of these legal structures already exist. So the starting point, in our view, would be to start from how securitized assets are now regulated in the traditional markets, i.e. the securities market, and then map that to a technology-neutral model on the blockchain basis. The underlying philosophy for us is the same. Innovation should be encouraged, but it should develop alongside strong governance and appropriate safeguards. So Vietnam has already made significant progress in establishing foundations for digital asset development. Recent policy initiatives, including the pilot framework for crypto assets, as well as the development of the International Financial Center in both Da Nang and Ho Chi Minh, actually paved the way for a clear commitment to exploring innovation in a structured way. And we welcome this as an organization. What's particularly exciting is that Vietnam is not just regulating new technology, it's actually building trusted market infrastructure more broadly that supports much broader economic development. The tokenization of infrastructure projects that's proposed in Da Nang is one example of how digital finance can connect with real-world needs for global capital, and more broadly, to support investment, improve capital formation, and strengthen Vietnam's position within the regional financial ecosystem, which the gentleman from the DIFC mentioned earlier in phase 4, which is the integration with other financial centers in the region. In our view, Vietnam doesn't need to replicate any other country's framework. You have your own legal system, market structure, and policy priorities. And while international experience provides a very useful benchmark, you have the opportunity to design a framework with your own economic objectives while using the negative and the positive lessons learned from other parts of the world in that development. Let's talk for a minute about what the economic benefits could look like if we get this right. We see this not as a technology discussion, we see this as an economic development discussion. One of the things that we've been focused on is how this allows the attraction of new sources of international capital into Vietnam's real economy. To give an example, if there's a tokenization of Vietnamese assets, and if the national priority is to make those assets available to offshore investors, and the legal frameworks allow for that to happen in a structured, orderly manner, then this could be a viable opportunity. One thing to bear in mind is that obviously international investors would take much more comfort in the fact that the instruments are also available for domestic consumption. And this is something to bear in mind as well. Now, at the same time, the opportunity works in both directions. A trusted regulatory framework can also incentivize and encourage institutions like us and eligible investors with a wider access to, with access to a wider range of global tokenized financial products, tokenized government securities, money market funds, bonds, and other investment assets, and to make them available to Vietnamese users. So this is almost like a two-way capital bridge. We connect domestic opportunities with international investors, but also give local market participants broader access in a controlled fashion to international asset exposures. The object is not just digitization. That is the back-end engineering. The objective is a much more efficient financial ecosystem and a much more two-way financial ecosystem that supports investment, innovation, and sustainable economic growth. Which brings me to my key message today. From our experience across APAC and globally, we've seen that the demand for much broader market access is real. As I mentioned before, when we launched our tokenized US equities and we launched our gold and silver perps and we launched our pre-IPO stocks, the demand was the greatest we've seen for a single asset class. And we say this having had the experience of being the fastest growing company before SpaceX and seeing the original demand for digital assets. But demand alone doesn't create a sustainable market. Trust does, which means we need to get the foundations right. In every market that we operate, we look forward to and we encourage legal clarity, not just for us as a market participant and the licensing framework around organizations like us, but we look for legal certainty at a product level. And that's actually the most important thing for users, because Vietnamese users in particular, based on our experience, are not particularly brand loyal. They're much, much more sensitive and much, much more alive to the differences in products and the nuances in products, and they look actually for a good product fit. They also look for strong custody frameworks, they look for effective governance, they look for transparency, and obviously they look for compliance. So centralized exchanges like us have a core role to play in local compliance and to send the message to our user base that we are a trusted brand in the market. Vietnam now has a unique opportunity to translate these global lessons, and there is actually a second mover advantage here, right, into its own model. Initiatives such as the Đà Nẵng International Financial Center provide an opportunity for market participants like us to test market infrastructure in a very controlled and responsible way. Because ultimately, demand creates opportunity and trust makes markets. Thank you.